All right, so welcome to our third live lecture. This week, we're going to look at general journals and ledgers, how to complete a general journal and post to the ledger. So that's what we're going to look at in, I believe it's what chapter, and I do not even know what chapter. Let's take a look at week 3. In fact, I have it right here, chapter 4. That's the chapter we were looking at tonight. So this week, again, similar from all other weeks, you have your discussion, your assignment, and assessment. And what we're going over tonight is we're do the PowerPoint, then hop into the assignment, give you a few pointers on that, and then hop into the assessment as what to expect on that. And of course, keep up with your daily checkpoints. Easy, 5 points per day if you do them accurately. And if you do them all, do them correctly, then you have a chance for 55 extra credit points. And the discussion this week, like I always do every lecture, is I go over the criteria. Again, I know you guys are probably sick of hearing me saying it, but there's still some people in the class that aren't hitting all the main points on the discussion, which again, make sure you have 3 posts in total, 1 original post, that's 150 words, and it's due by Wednesday of each week, and then you have 2 responses to students of 50 words or more each by Saturday. And of course, make sure you stay on the topic, which this week we're talking about technology and how it's changed the accounting profession. And the main thing is, automated accounting software like QuickBooks, Peachtree, Sage Mass, how much they've changed the accounting profession because, like 30 years ago, everything was done by hand, pencil and paper. I mean, like you'll see tonight when we do the assignment, when you complete the general journals and then you have to post to the ledger, and then you have to create a trial balance, and then from there you create financial statements, and that would take, hours to do. Plus, it's easy to make a mistake adding, whereas today you put it in the software, you do a journal entry, and it posts, creates a trial balance, and creates financial statements for you. Everything's automated. So what took like hours years ago literally takes minutes. That's why the accounting profession now, instead of being a number cruncher where you just sit in a cubicle all day and crunch numbers, it's more focused on financial analysis because you don't have to do the data entry. Instead, you can analyze the financials and interpret the numbers to people. You can spend more time on it. So that's what your discussion centers around this week. And like I said, all the criteria is right here. If you follow all of that and you stay on topic, and you're free of spelling and grammar errors, then there's no reason why you shouldn't get a 60 out of 60 on the discussion. So that is your discussion this week. And then you also have an assignment and assessment, which again, we will go over once I go through the PowerPoint. Do you guys have any questions for me before I begin the class in general? Here, Mike, let me just get that. Okay, so far so good. That's good. Good. And then just make sure you aren't hitting your microphones. So there, that one is off. The transactions for assignment 3. Okay, well, we will go over that when I go into the assignment where you're going to put the transactions, because you want to do the general journal. You'll see there's a sheet set up for your general journal. Your general journals, you put them in there, and then you post to the general ledger and then complete your trial balance. But we're look at all that in the assignment right after I go through the PowerPoint. But yeah, that's why I always like to go over the assignment, because sometimes the instructions are vague on what to do. All right, so this week, like I said, we're looking at the general journal and the general ledger and posting, recording transactions in the general journal, preparing journal entries, and posting entries. In the accounting cycle, we are in step 2 now, journalizing the transaction, and I believe we're going to look at step 3 as well, which is posting transactions to the ledger. So a journal is essentially what you see on the screen. It's a diary of business activities. It's essentially the listing of what encompasses the business. And there's various types of journal, accounting journals. I mean, there's general journal, there's sales journal, there's purchases journals. They're all kinds of journals. We're going to look at just the general journal. And these transactions are entered in chronological order to keep everything organized. So you want to enter them in chronological order. And here's an example of a general journal. Like this is one. Just getting a mic. And let me just update my attendance because there are some people filtering in. So let me just record that. So this is an example of a journal. And you always, with general journals, which like we learned last week, you always have to have at least one debit and at least one credit. The debit is always first, the credit is always second, and it's always indented too. And debits always have to equal your credits. So you could have 600 debits and one credit, just as long as you have one of each, and in total, they both equal. So debits have to equal credits. In a general journal, debits are first, credits are second, and they're indented as well, and they must equal your debits and credits. So this one would be an example of if Karen Wells invested $100,000 in the business, because remember from last week in your T accounts, when you invest money into the business and its owner, you want to increase your capital, credit, because remember, capital has a normal credit balance, and then you also want to increase your cash, which is a debit, because it's an asset, which has a normal debit balance. So when recording a business transaction, there's 4 steps that you can follow, which we kind of looked at last week too in the PowerPoint, which is analyze the financial event. Identify the accounts affected, classify the accounts affected, and determine the amount of increase or decrease for each account affected. And then you want to apply the rules of debits and credits. Which account is debited for what amount, which account is credited for what amount. That's where I said about last week is why you want to know all those accounts, those normal debit and credit balances. That's why it's so important to remember those, like assets, expenses, and draw-in accounts have a normal debit balance. Revenue, liabilities, and owner's capital have a normal credit balance. And then you make the entry in T account form, which we learned last week. So we learned 1, 2, and 3 last week, and now we're incorporating number 4, which is record the complete entry in general journal form, which again is this right here. It's essentially the T account in general journal form. That's exactly what it is. It's just duplicating it, but in general journal, in a general journal form. So there's also what's called ledgers. And these ledgers are a separate form for each account. And as you saw in the first slide, it's the 3rd step in the accounting cycle. And the process of transferring data from the journal to the ledger is known as posting. So after you do the general journal entries, you would then post these entries to each ledger account, which this is where you're going to see in the homework how tedious this is. But when you use an accounting software, once you complete the general journal, it does all the posting for you. It's automatically automated. An example of a ledger account is, here's one with cash. It lists all of the transactions for the account. So you'd have one for cash, accounts receivable, prepaid rent, sales, every account would have its own ledger. And in that ledger would have details of all the transactions. You can see if we use the example from here, this cash Karen Wells, you can see this 100,000 is posted in our ledger. We put the date. The post reference is J1, which means journal, page 1, and that comes from right here, page 1. And then you put the amount, 100,000 debit, and then the balance, since it had a zero beginning balance, it's 0 plus 100,000 equals $100,000 debit balance. And then there are 5 steps for posting, which I kind of just hit on just a little bit ago. But let's look at the last 5 slides because that's what they are, the 5 steps. So this is posting a general journal to the ledger. So step 1, you want to put the date in. So you take the general journal date and put it on the ledger for the date. So November 7th, 2013, November 7th, 2013. Next, you put the post reference. J refers to general journal and 1 refers to page 1. Step 3, you transfer the amount. Okay, it's a $5,000 debit to equipment. We're looking at equipment, $5,000 debit. Then 4, you want to compute the balance. Well, since it had a $0 beginning balance, 0 plus a $5,000 debit balance gives you $5,000 left. And then the last step is to put the account number in the post reference in the general journal to show that this was posted. So first step, put the date. Second step, put the post reference for the ledger account. Third step, put the amount of the transaction. Fourth step, compute the balance. And then fifth step, put the post reference in the general journal to show that it was posted to the ledger. And this will make more sense when this is essentially what your homework is. It's completing the general journals, posting to the ledger, and then completing a trial balance. Any questions so far on that? Good, good. Yeah, and that's fine if you have questions later. Like I always say, ask questions. Because this is talking about the individual transaction. So equipment had a $5,000 journal entry, which is right here. So $5,000 debit goes here. Over here is the running balance of the account. So if the account, say you posted another $2,000 to this account, a $2,000 debit, that means the new balance would be $7,000 because you put $2,000 here and then $5,000 plus $2,000 equals $7,000. So that's what this side is. It's a running balance. This side is just talking about the individual account. Yeah, I mean it depends on the general journal. I mean, you could have a a credit to equipment to decrease equipment. It just all depends on the general journal entry. So yeah, it can be a debit or a credit. It just depends on the individual transaction. Cash you would post as well. You post that to the general ledger for cash as well. This is just showing the equipment. It's just giving you an example, but you post for cash as well. You take that $5,000 credit and you make a $5,000 credit entry to the ledger on cash. The post reference, again, is for the ledger. It means J for journal and page 1. And then this post reference is the account number, which is 141, which shows that you posted to the ledger. Typically for postings, you don't have to put a description in the ledger because you're posting. So there doesn't have to be a description in the ledger. Because when you drill down on this account, then it will bring up the general journal, which shows the detail. All right, so that is the PowerPoint. Like I said, it was a pretty short one. So let's look at the assignment. So let me just bring this up. And a lot of these transactions are I think actually all the November transactions are similar to last week's, or the same as last week's, I mean. So let's open this. Okay, so for this hallmark, you can see you have 2 tabs, the General Journal tab and the General Ledger tab. You have to complete, and all the transactions are right here. Here's all your accounts, and here's all your transactions. You have to complete each transaction and put them in general journal form in the general journal. So each transaction you put in here in the general journal. And then after you put the transaction, complete the transaction in the general journal, then you have to post them to each individual ledger account. You can see there's one for cash, one for AR, prepaid rent, computer equipment, office furniture, everything. And then after that, you want to complete your trial balance. And all a trial balance is, it's a listing of your accounts and your balances. So you can see they're already listed here for you. So after you post all of your entries, you're going to have an ending balance for each of these. And that ending balance, you're just going to put on the trial balance because it's just listing your accounts and their balances. That's all a trial balance is. It's a listing of all your accounts and your balances. And I hear a mic. Let me get up. All right. Let me just see, a couple more people came in. Let me just update attendance again. There we go. That's where it all goes back to knowing your normal debit and credit balances. Remember from last week, you have assets. Well, let me put this. Assets, expenses, drawing, and over here you have liabilities, revenue, and capital. Remember, these have normal debit balances. These have normal credit balances. What that means is assets are increased with debits, assets, expenses, and drawings are increased with debits and decreased with credits, and liabilities, revenue, and capital are increased with credits and decreased with debits. So you have to look at each individual transaction and you have to identify what accounts are going to be affected. So let's take a look at the first one. And these November ones are exactly the same as last week's transactions. So if you did last week's transactions correct, then you should just be able to easily put these in general journal form. So for instance, J. Jones visits her local bank and withdraws $50,000 from her personal savings account, depositing the cash into a new bank account in the name of the business, Smith Consultants. So rules of debits and credits. Remember, you have to have at least one debit and at least one credit, and your debits have to equal your credits. So in this case, the owner of the business is taking her own personal money and putting it in to the bank account. So the account that's going to be affected is cash. Your cash is going to increase. The opposite of that is your capital account is also going to increase as well. And here you have to know, well, cash, that's an asset. Assets have normal debit balances, so they increase with debits. Capital is the opposite. It's a equity account, which has a normal credit balance, which means it increases with credits. So that's why I said last week is such an important chapter, because everything's carrying over. And as you can see, that's already carrying over in this week. So in general journal form, you put the dates, the 3rd, and then you put the accounts that are going to increase. In this case, we have our cash increasing. Remember, debits are always first, and it's $50,000. Then we want to indent her credit. Who was it? Smith, J. Jones. So J. Jones capital, $50,000. And in the description, you can just put, anything you really want, just as long as it gets the gist of it. Initial investment by owner, because again, she's putting money into the business. If money is going in, cash is increasing. Cash is an asset. Assets increase with debits. So we want to debit cash $50,000. Since she's increasing her investment in the business, you want to credit capital, because capital is a capital account. It's a normal credit balance, increases with credits. Then, and you can either do this one of two ways. You can do all the general journals and then post, or you can do a general journal, post, however you want to do it. I'm just going to show you right now how to do the posting so you have an idea. You should put something under there just to show what it is. Like I said, it can just be the gist of the transaction, like this one, initial investment by owner. So the next step, we have to post these to each ledger. So cash is a debit of $50,000. So we want to go to the general ledger, find cash up here, it's November 3rd. The post reference is J1, which again means J for General Journal, and then 1 for page 1. And then it's a $50,000 debit. And then the balance, since the beginning is 0, that means your balance is 0 plus 50,000, 50,000. And then we want to take the account number 101 and put it in the post reference. Same with the second one. J. Jones Capital, 50,000 credit. Go to the general ledger, find J. Jones Capital, put, I think it was 2015, November 3rd, post reference J1, 50,000 credit, 0 plus 50,000, 50,000 credit balance. Account number 301, post reference 301. And another key with this spreadsheet is everything that's filled in yellow is a good indication of what should have something entered in it. And again, like here, it gives you, you can see 2 spots for the description. Same with here. You can see there's 2 debits, 1 credit, and gives you 2 spots for the description. But you don't have to fill out both for the description. But that's a very good indication that everything highlighted in yellow needs to have something entered. Same with the general ledger. You can see there's a bunch of yellow boxes. That's a very good example that everything in those yellow boxes should have something. Yeah, I'm going to do a couple more. I'll do one more, and then I'll let you guys pick a couple of them. Don't pick any of them yet because you can review them right now and see which ones you have an idea of. But I would highly suggest to not pick any November transactions because, again, all these transactions in November are the exact same ones you saw last week when doing your T accounts. So if I were you guys, I would want me to pick some December transactions. So I'll do the first December transaction on December 10th. And I am actually going to skip on the spreadsheet. Like I'm going to do the December one the whole way down here just because to keep it in chronological order. So let's do December 10th it was. So let's look at this one. Jones Consultants purchases $3,000 of computer equipment from Elite Computing. They issue check 1007 for $1,000 with the balance due in 90 days on invoice 8009. So if you're purchasing computer equipment, your computer equipment is going to increase because you want to recognize that asset. So your debit is going to be computer equipment for $3,000. And you're going to have 2 offsetting credits because they issue the check for $1,000 with the remaining balance due in 90 days. So if they issue a check, that means your cash is going to decrease by $1,000. And since the remaining they didn't pay and said they'd pay in 90 days, that means you're going to increase your accounts payable by $2,000 to show that you still owe that money in 90 days. And the description, you can just put purchase computer equipment with check and remaining on account. Again, you can just do like a short description like that. So what's the next thing we have to do for this transaction? We have to what? Exactly. We have to post to the ledger. So we have 3 accounts to post. So the first one, computer equipment for $3,000. And I think that's the only one in that account. So let me just see something real quick. No, it's not. There's a couple. So computer equipment, debit of $3,000. We go to computer equipment. And again, I'm going to skip around on this because we skipped a bunch of November transactions. So this December one would be down here. The post reference is J for General Journal, but it's page 2 because again, we're on page 2 for December. And it's a $3,000 debit balance. And I'm actually going to give you these balances right here, 2, 6, just to show you that, okay, we have a $6,000 balance before this transaction. 6,000 plus 3 equals 9,000. And then the 141 you do in the post reference. Same with your cash. You'd have to post this one too. So again, I'm jumping around because again, this December one is posted here. Post reference J2 for page 2. It's a 1,000 credit. And I guess I have to give you all of these balances, so it will definitely be helpful for you guys when you're doing this homework because you have a lot of check figures. Again, I'm just giving you these balances because there are transactions before that, but since we skipped all of them, that's why I'm skipping down to December. So 44,200 debit balance minus $1,000 credit gives you 43,200. And then the post reference 101 we put here. And the same with accounts payable. We have to post this one. So it's a $2,000 credit. Let's find accounts payable. December is going to start here. December 10th, J2. It's a $2,000 credit. The balance beforehand was 4,000. So 4,000 credit plus a 2,000 credit equals 6,000 credit. And then the post reference 201. Making sense? You can see how tedious it is. Like I said, when you use an accounting software, once you do the general journal, it does all the postings for you. Good, good. All right, so I'll let you guys pick two more. And first come, first serve. So you tell me which ones you want to see. Oh, I'm definitely glad for accounting software because if I had to do this stuff by hand, it'd drive me nuts. And I couldn't even imagine when they didn't have Excel, you'd have to do everything by pencil and paper. All right, December 16th is one of them. All right, so let's look at December 16th. Okay, so let me pull up over here. All right, December 16th. Jones Consultants receives a check from Speedy Freight for payment of invoice 101 from November for $1,000. So this transaction is going to go down here because we just, again, keep it in chronological order because the 15th is before it. So we're going to look at the 16th. So if we receive a check, that means our cash, if we receive a check from a payment of an invoice that's already recorded, that means our cash is going to increase and our accounts receivable is going to decrease, which they are both assets. So in this case, if we want our cash to increase, we want to debit it. And if we want our accounts receivable to decrease, we want to credit it. And the amount was $1,000. Because again, when you're receiving a check, money's coming in, so cash has to increase. Cash is an asset. Assets have normal debit balances, so they increase with debits. Accounts receivable, because again, you're paying, they're receiving payment from an invoice that was already issued, so you already increased your accounts receivable. Now you're receiving payment, so you have to decrease your accounts receivable to show that that customer has paid their invoice, so you credit accounts receivable. And you could just put receive payment from Speedy Freight. Okay, and then I see we got our next transaction, December 18th, so we'll do that one after this. So post our cash, $1,000. So we just go, it's a debit cash. So we go up, find our cash, and it's this one right here. So 16th, J2, $1,000, 43,200 debit plus a $1,000 debit gives you 44,200 debit. And then our post reference 101. Accounts receivable credit of 1,000. So we find our accounts receivable, and I believe that one, let me make sure I'm putting this one in the right place. And that was December, which one? 16th. So that one's going down here. J2, 1,000 credits. The balances before that were 5,500. So $5,500 debit minus a 1,000 credit gives you a remaining 4,500 debit. And then the 111 gets put in the post reference. No, it definitely is. You should put the invoice number in there. Like I said, you don't have to, but essentially with descriptions, the more detailed, the better. In this case, I was just putting the gist of it for time purposes, but you're absolutely right. You could put the invoice number in there, and typically that's what you see in businesses. So like the invoice number 101, receive payment from Speedy Freight on invoice 101. You could do something like that. All right, so you guys said the 18th is the next one you want to do. So 18th, it's going to go right here. Jones Consultants issues check 1008 for $1,500 to Elite Computing to pay invoice 7964. So this one is actually good to do because it's the opposite of the last one that you just did. In this, the one we just did, cash was coming in the door. In this one, cash is going out the door for a vendor payment. So in this case, we want to debit, decrease accounts payable, and credit, decrease cash. Because again, cash is going out the door. So you're going to decrease cash for $1,500. You're paying a vendor for an outstanding invoice. So you want to decrease your accounts payable because accounts payable is a liability, which means it has a normal credit balance. So when you pay down the liability, you want to debit, decrease the liability to show that it's been paid. And then in the description, you can put issue check 1008 to Elite Computing for invoice 7964. And then we would post. So accounts payable, debit 1,500. So we want to go to our accounts payable, 18th, J2, 1,500, 6,000 credit minus a $1,500 debit gives you a $4,500 credit balance. So accounts payable, 201, and then cash 1,500. You just go up here, 18th, J2, 1,500, and then 44,200 debit minus a $1,500 credit gives you 42,700 remaining balance. And then the account number 101 would go here. So after you do all these journals, after you post them to the ledgers, then your ending balances in each ledger account, you want to put down here in the trial balance. And then at the end of this, your debits should equal your credits. So your check figure is $67,200 to show that your debits equal your credits. $67,200. So you guys have a lot of check figures in here from the balances and of course the remaining balance on the trial balance. And plus you have a good start. You have 4 transactions completed, plus all the November transactions are the same as last week's transactions. Well, all your trial balance is it's just listing your account balances. So after you post everything, you're going to have an ending balance. Like you're going to have a balance here for cash, here for AR, here for prepaid rents, computer equipment, office furniture, accounts payable, J. Jones Capital, drawing, fees income, rent expense, utilities, and salaries. And you're just you're just copying these exact numbers down here. So, for instance, J. Jones Capital, their ending balance is a $50,000 credit. So you just go down here, J. Jones Capital, $50,000 credit. That's all you're doing for the trial balance. So you do that for each individual account. Like computer equipment, you guys already have the ending balance. So it's a debit of 9,000. So you go down here, computer equipment, debit 9,000. And after you do this, your debits should total to 67.2, credits to 67.2, and they equal. That's all you have to do with the trial balance. It's just a listing of your accounts. Pretty straightforward. I know you guys probably have a few questions, so it's no big deal. Just like I always say, email, call, or text me. But with that said, I'm going to hop into the assessment now because we have about 10 minutes left, which should be enough time to get through it. So let's bring that up. Okay, so your assessment. Once I bring it up. Okay, so your assessment, you have 120 minutes to complete it. So you have 2 hours, plenty of time, and it's worth 50 points. It's only 19 questions, and they are all multiple choice questions. So 19 questions, all multiple choice, worth 50 points, and you have 2 hours to complete it. So like with every week, you have plenty of time to complete it. A lot of these questions center around, obviously, journal entries, to record, utilities expense, what account would you debit? Questions like that. So, to record the payment of salaries, the entry to that would be debit to salaries and credit to cash, because you're increasing salaries, decreasing cash. So again, to record salaries, debit salaries, credit cash. Know that when you make an entry to the general journal, you always record debits first. Again, you always record debits first. The entry to record prepaid rents would be a debit to prepaid rents and a credit to cash, because you're increasing your prepaid rent, decreasing your cash. If you purchase equipment by issuing a check and paying the rest in 90 days, then you would debit equipment, and your credits would be to cash and accounts payable. So again, you would debit the equipment and credit cash and accounts payable. When revenue is earned from charge account sales, you would debit the receivable and credit the revenue, because you'd recognize the receivable and then recognize the revenue. So earned from charge account sales, meaning you're purchasing on accounts, you debit receivables to increase it and credit revenue to increase it. A journal entry to record the withdrawal of cash by an owner would be a debit to the drawing account and a credit to cash. Again, debit to drawing, credit to cash. You increase the drawing, decrease the cash. Journal entry to record revenue earned and received in cash is debit cash, credit fees income, because debit cash to increase it, credit fees income to increase that as well. You can see there's all of these questions center around journal entries. So that's why it's so important to understand these journal entries. Journal entry to record purchase of equipment with a $100 cash down payment and a balance of $400 due in 30 days would include you debit the equipment for the full amount, which would be $500, and then you'd credit your cash for $100 to recognize the cash down payment, and then the remaining $400 would be credited to accounts payable to show that you still owe that money. Same with if you purchased a forklift for $10,000, your debit would be to forklift or equipment expense for $10,000 to recognize the equipment, to capitalize it. Again, remember that journalizing transactions, debits should be entered first. And a compound journal entry is a journal entry with 2 or more accounts debited or credited. That's a compound journal entry. And know that the general ledger contains, oh, I did something right there. Know that the general ledger contains accounts that are used to prepare financial statements. Again, the general ledger contains accounts used to prepare financial statements. And the general ledger accounts are usually arranged in balance sheet accounts, then in income statement accounts. So you have your balance sheet accounts first, and then your income statement accounts. The posting reference column in the ledger relates to the journal page number. Again, that's the posting reference column in the ledger that contains to the journal page number. Correcting entries are required when an error is made in recording a transaction. And also know that correcting entries are required for any errors in recording transactions. So again, correcting entries are required when any error is made in recording a transaction, and they're required for any errors in recording transactions. Essentially the same question, just flipped around a little bit. Yeah, with the assessment, I'm just giving you pointers as what to expect on it, but I don't have the actual assessment up. But for the most part, like I said, I'm not giving you verbatim questions, but these are very good indications of what you're going to see on the assessment. And also know if an error in a journal entry is discovered before the entry is posted to the general ledger, the error in the entry should be crossed out and the correct data written above it. So if you make an error in the journal entry and it's discovered before you post, then just put a cross through it and correct the data written above it. And of course, remember, this assessment is basing off, like, you know, if you're doing everything by pencil and paper, but obviously no one uses pencil or paper anymore. If you're using a computerized software, then you'd simply just delete out the old account and put in the correct account. Yeah, you put a cross or line through it, but again, that's if you're doing pencil or paper, but who uses pencil or paper anymore for accounting? You'd simply, if you're, for all intent purposes for you guys, you'd simply just change the account in the accounting software. And let me see if I missed any up. If your accounts payable has a $3,000 credit balance and an entry for the payment of $1,000 on amount owed is recorded and posted, then the new account balance is $2,000. Because if you have a $3,000 credit balance, you have a payment of $1,000, 3,000 minus 1,000 equals 2,000. And the last one, if you purchased equipment for $4,500 in cash, and by mistake, the journal entry debited the office equipment account rather than shop equipment account, then the correcting entry would simply be, to debit your shop equipment and credit your office equipment for the $4,500, just to switch them around. Any questions or anything? All right, perfect. Always good when that's the case. Yeah, no problem. Like I said, if you have any questions, email, call, or text me. But with that said, that's all I have for tonight. Whenever the discussion, assignment, and assessment. If you guys have any questions in the meantime, like I said, email, call, or text me. If not, then I'm sure I will see you guys next week. With that said, I'm going to go ahead and end the lecture. Have a good night, guys.